everybody. My name is Aman and I'm an investment coach at Sage Investors, and welcome to another edition of Stock Talk. Today I want to talk a little bit about contrarian investing. One of the things I do as an investment coach is kind of make people more aware about some of the behavioral biases that we have that kind of clouds our judgment and leads us to making not exactly the greatest investment decisions. And one of the big ones that we all face is sort of the group herd mentality, in terms of following what the herd does or following what the consensus people do or what the smart money people are doing and making investment decisions accordingly. And a lot of times that kind of leads us down a really wrong path. And one of the things I try to do, basically one of the reasons why, is because as humans, we want to belong to something. We want to be part of a winning team. So if everybody's buying Apple stock, then you gotta go, hey, I gotta go buy some Apple stock because that's what's out there. So that's what's cool. That's what's in. So, and a lot of times, following kind of what the bandwagon's doing in an investment from an investment perspective, kind of leads you down a wrong path. And so, one of the things I try to get people to do, and when I coach them, is to make them more aware of this herd mentality and kind of explore the other side of the trade and be willing to take the other side of the trade and swim upstream. And that's pretty much what contrarian investing is all about. And from my perspective, I think developing that discipline or that emotional discipline to withstand those pressures out there can go a long way to be a more successful investor. Reason why I bring it up about contrarian investing is there's a really good article from Ben Carlson in his blog talking about contrarian investing, and basically saying it's if you go hardcore contrarian investing, it's not exactly the greatest, may not be the greatest thing. And he cites a really good example of if you took at the end of 2014 the worst performing stocks on the S&P 500 and you invested in them, and if you took the worst performing country ETFs at the end of 2014 and invested them in 2015, you would have had the loss. You would have got all 10 of those stocks, and all 10 of those ETFs would have lost you money. Basically, the average loss for those stocks in 2014 was 23%. So if you invested in those stocks, i.e. take a contrarian position on it, you would have got an average loss of 38%. For the country ETFs, the loss in 2014 was 31%, and so if you invested in those ETFs in 2015, you would have got a loss of 25%. So basically, the argument he was making is that going through taking contrarian investing is not necessarily a sure bang way of getting supersized returns. And I agree with him to a point. The numbers don't lie, like they make sense. But I think the 1 year time horizon is a little bit too short from that perspective, because the reality is when you take the other side of the trade, you better be really willing to ride it out for a longer period of time. And to give him some credit, he actually made some points about contrarian investing that are things that should be taken into account when you're taking that other side of the trade, and I think they make a lot of sense, and I thought I'd share some of them with you. First point I'd have is you got to be patient. And as I said, when you're taking the other side of the trade, you better be ready to ride it out and be ready to hold that position for a long period of time, because as I said, out of favor stocks, out of favor ETFs could stay out of favor for a long period of time. So you better be patient and be willing to stomach some of the volatility that comes around that. And that comes all again about being disciplined and again aware of understanding some of your behaviors and biases that you have. And it's a tough thing to do because, as I said, we're wired to we want to be on the winning team. And so when you're buying oil stocks right now, when oil prices are tanking, it's a tough thing to do. Also understand when you're taking that contrarian position and making contrarian investing, it's a lonely process because chances are you might be the only one out there with that belief, and a lot of times you're going to open yourself up to some ridicule and some jabs and saying you're insane, you know what you're doing, and it's tough. So, but at the end of the day, it's also lonely at the top. Other things he talked about is anchoring to past price points. So if a stock falls from 50 to 20, buying a stock thinking it's going to go up to 50 that's not realistic, because a lot of the fundamentals of the business have changed, the fundamentals of the market have changed, and so that's not what it's about. It's not about getting back to what it was before. So when you're buying a stock anyway, you should be buying it with a specific return in mind. If you believe the stock is valued at $50, then that's fine. But if you're looking from a perspective of trying to get your own personal return, saying I want to earn about 10-15% on my investment, then that's kind of a more realistic way to approve it instead of anchoring to a past price point. He talks about the single country ETFs containing much more risk than you normally would think of, and it makes sense because a lot of times when you look under the hood of individual country ETFs, it might be concentrated in one or two stocks. Like for example in Finland, the Finnish stock market, Nokia makes up a significant portion of the Finnish stock market. So even though you're buying a Finland ETF, you're essentially buying Nokia, and so it's important to do that due diligence and look under the hood and seeing exactly what you're buying. And ultimately, the other thing he talks about is the timing. You might take a contrarian position, but it may not pan out for years or many years or multiple years. So again, it comes down to that patience and everything. So I kind of believe in the whole concept of contrarian investing, but I don't believe in that if you think if the market thinks that oil prices are going to go to $10, that you go out and back the truck up and buy every oil stock out there. You still have to do your due diligence. You still have to understand how some of these companies and businesses operate and find out which are the best ones that can withstand a price shock and a price fallback, and ultimately buying those best companies, because it still comes down to your investment ideology. And for me, it's about buying well-run, well-managed, high-quality companies that can generate high returns on capital and have clean balance sheets to withstand shocks that can happen in the market. So Mr. Carlson, he makes some good points on that, but I agree with a lot of those points. But I think the concept of going a one year, and as a contrarian strategy is a riskier proposition. So I just thought I want to share that out there with everyone. That's all I got for you today. Thanks for watching another edition of Stock Talk. You can follow me on Twitter. My handle is @SageInvestors. I tweet all my market observations, mind mapping, what I'm thinking about when I'm making investment decisions, as well as all my trades, buy and sell trades that I do on a daily basis and in real time. If you want more information about my investment coaching courses, services and coaching courses, you can check out my website at www.sageinvestors.ca. Again, my name is Aman and from Sage Investors, and thanks for watching looking at Stock Talk. I'll catch you again.